Hi, Doug. Thanks for joining us today.
Yeah, thanks for having me on.
Not a problem. I know today we were going to talk a little bit about 60/40 portfolios, kind of the standard way a lot of people go about investing. I know you've got some opinions on that. I've got some opinions on that. A strategy that's been pretty successful, generally tends to be pretty successful. I think we both, though, have some cause for concern about that maybe not being set up to have the kind of success it's had in the past.
Yeah, well, I mean, I think it's a timely topic. It's certainly been in the headlines recently. I think some of the bigger houses, some of our competitor firms trying to suggest that the 60/40 portfolio might actually be dead, might not be a good strategy for you going forward. I certainly don't think that that's the case. It's certainly been a tough year for the strategy, but I would say it's more, that the strategy has more been knocked down, but not KO'd.
Yeah, and we should probably kind of, for those that don't fully know what the 60/40 is, that's generally about 60% to the S&P 500, US large cap index, and then about 40% generally to a bond index that's representative of the market. There can be some tweaks on it or whatnot. Some people might carry a little bit more than that split as they get towards retirement. They might go heavier on the bond portion than the stock portion. The bond portion might be made up all of treasuries rather than a broad bond index, but generally you're looking at a broad bond index coupled with the S&P 500 and a passive investing strategy where you're not using active management. And that strategy has in the past outperformed a lot of active managers, and it's become extremely popular, given how well it's performed, how low fees it has, and just how well it's done. I think one concern we have with the firm would be the S&P 500 side, which we've really we benchmarked to, and we really deviated from. We're really not holding stocks that mirror the S&P 500 anymore. And that kind of goes to how that index, I think, has gotten very concentrated in a few just very large names, and how it's also gone very, very focused on being representative of growth stocks. And it's kind of become a very kind of mega cap, huge growth stock index rather than really a diversified stock index.
Yes. Just
Mhm.
just to recap a little bit, I mean, this strategy has been around a long time. It's a simple strategy. It's kind of what we at Alhambra look at as kind of like a baseline strategy. So two really large slices of the pie, and then we would fill in the equity piece with a variety of different exposures. It's the strategy has certainly benefited from indexing. There are certainly benefits to lowering costs with the strategy because it's so simple. And really what we're talking about with the strategy is you have your income side and then you have your capital appreciation side. And so one of the major diversifying benefits of this strategy is that as the equity risk premium bounces around, say historically between 4.25%, maybe as low as 3.75%, all the way up to 5.25%, you get rebalancing opportunities. And so while the steady 40% part of your portfolio is giving you income, it allows you, when your 60% goes down a little bit, to buy some. And as it goes up a little bit, maybe outperforms, you sell some, and you tend to gain some alpha from that. The strategy has probably returned close to 8% with a little bit over a 9% standard deviation. So a Sharpe ratio just below 1, which isn't too bad, especially given the costs.
Yeah, and so maybe we'll start off talking about some of the things that's good about the strategy. I mean, I can talk about some of the things I like before kind of going in and talking about all the things I don't like about it right now. But some of the things are absolutely, it's a low cost strategy. because you're using passive indexes, this isn't going to cost you a lot. It's a low turnover strategy. It's a fairly tax efficient strategy. A lot of investors, when they make changes, they actually detract value. Being a passive strategy, it avoids a lot of that. You are buying a pretty good proxy for the U.S. economy by buying the S&P 500, by really investing on where the money is. You are getting a historically pretty good proxy for the U.S. economy. And then, the bond portion does bring, your volatility down. Typically what we see in the typical recession is that the Fed will have to go in and cut rates. And generally that's positive for bonds. Generally in a recession, you get a flight to quality. Investors will sell riskier assets and move to safer assets. So in general, with those kind of conditions, that bond portion will help you out and offset the losses from your stock portion, lower your overall vol. So there's a lot to like about the strategy, as well as what you've kind of already stated, that historically this has generated a pretty good, consistent rate of return. Those are all things, I like about the strategy. I think as a firm we like too, and we certainly do try to incorporate a lot of those elements: the diversification, not having too much risk to any one stock, the value of having that bond portion. Not talking about like low grade corporates or junk, but actually like treasury bonds where they're going to benefit from that typical recession cycle. I think those are some of the things I like about the strategy, and I would kind of list on the positive side for it.
Yeah, the diversification, the ability to gain alpha from rebalancing, and you're right. Really, we like to think about as allocators of capital, where our capital is being allocated. We like to spread it across the entire spectrum of investable assets. In this country, and fixed income is the main first place where you would invest your money. And then we can go into the negatives of the strategy. It is an index strategy, so you're not potentially getting that alpha from individual stock selection. And some of the diversification benefits tend to not be sustained in any one given year. So this is a strategy that was built based upon data over a long time horizon. And so when we look at any given 1 year, the strategy can tend to have poor performance. If you look at it over time, 35 years plus, the strategy will have a lot better performance.